Welcome back, everyone. I hope everyone enjoyed lunch. I'm excited to introduce our next panel. We're going to talk about inflation. So despite the low level of interest rates, the inverted yield curve, and some of the things that President Kaplan talked about, inflation is still a very real concern, and our next group of panelists are going to discuss it. Moderating the panel is our own member of our own faculty, and it's, excuse me, Jeff holds the James F. Cleary Chair in Finance here in the Finance Department at Boston College. His teaching and research interests are in the area of corporate finance and capital markets. His research pieces have been published in the top academic journals, and he's won numerous awards. He edits many journals, including the Journal of Wine Economics, which I'd like to learn more about, Jeff. But I'll turn it over to Jeff Pontiff. He'll introduce his panelists, and we'll talk about inflation. Thanks.
Thanks a lot. This panel got started because I don't know anything about inflation, but it scares me. Okay, as an investor, what's going to happen if inflation picks up a lot? So that's how this got us started. And we're lucky to have two exceptional people. One is Peter Ireland. I've known Peter since I was in a undergrad at Chicago. Peter was the person I went to then for help with my economics. Peter is in the economics department now. He is the Murray and Monti chair there. His research focuses on macroeconomics, monetary economics, and the effects of Federal Reserve policy. So he is perfect. He is a member of the Shadow Open Market Open Market Committee. He is a research associate at the National Bureau of Economic Research, and he has held past positions at Rutgers and at the Federal Reserve Bank of Richmond. Eric Peters is the founder and the CIO of One River Asset Management. So they are a macro and systematic firm focused on identifying multi-year investment opportunities in global equity, interest rate, currency, and commodity markets. Before Eric started First River, he also worked for Credit Suisse and for Lehman Brothers. He travels a lot. He speaks with policymakers, business leaders. Every Sunday, he puts out an email called Weekend Notes. And I can't emphasize enough, if you're interested in finance, what's going on in the markets, this is a great email. Every Sunday, I get the New York Times, get the Boston Globe. I almost never read it, but I read Eric's email. So I highly recommend that. Not only is it insightful, it's incredibly well written. So great. So the title is "What Does the Future Hold?" Okay, kind of a dangerous topic. Okay, so what I want to talk about is why inflation scares me. Okay, and to a large extent, I lived during this period, 1960 to 1983. Okay, during this time, inflation approached 15%. Okay, and as Cliff Holderness, I don't know if he's here, has said to me, people hate inflation. Okay, even if people's wages are going up at the same rate, there's this feeling that you're losing. Back during this time period when I was growing up, I felt like everyone was miserable. And I would blame inflation for that, okay? And there's a long history of government policy. One is Gerald Ford's campaign. He was in office for a short period of time. One of the first things that he did was he had a speech and he said, it's very important we have to whip inflation now. That was in 1974. 10 years later, it was still there. So the now wasn't very useful. So the big thing of this policy was to distribute these buttons. And my dad had one of these buttons, and I would ask him, well, how are we going to whip inflation? He said, I don't know, but if we all wear the buttons, maybe that will help. Okay? So that government policy really didn't help. During this time period, we had price controls. These were designed specifically for gas prices. Did price controls work? No. Of course, the government decided instead of getting rid of the price controls to do things like having odd, even gas lines. So if your license plate ended in a 3, you could only get gas on an odd day. And again, that was yet another policy with questionable usefulness. Okay, so today, what is going on? We had a little bit of an inflation scare last year. Lately, things go back and forth. I think to ask the average person on the street, though, they'd say, hey, I'm not worried. Inflation is 1.5%. The Federal Reserve has tried to get the rate back up to 2%. They have failed, and we will talk a little bit about that. Many of you in this audience have no memory of the 1960 to 1984 time period, okay? I would go around, most of the assistant professors that I work with said, when, what does that mean? Okay, so they were, many of them were born after this time period. John Templeton has this quote, the 4 most expensive words in the English language are, this time it is different. And I think this is why inflation scares me so much. It doesn't look that bad, but I really fear that if it came back, it could be a pretty serious problem. Okay, should investors worry? Well, look, first of all, clearly, if you're a fixed income investor, unexpected inflation will eat dramatically at any fixed income contract, the value. Now, for equity, it depends, okay? Firms, when inflation picks up, it's possible their revenues will pick up at the same rate as their costs. Possible, okay? But let's look at the reality, okay? So what I did was I looked at our data on stock returns between 1925 and 1959, and then between 1984 and 2018, okay? So I took this great inflation period out of the data. Okay? During this time period, and by the way, this time period, we had World War I, World War II, the stock market crash of 29, the stock market crash of 1987. We had, we had the financial crisis, we had the NASDAQ bubble, okay? So this was no fantasy period. Yet, during this period, okay, this is inflation wasn't that bad, 2.1%, but stocks outperformed T-bills by 9.1% annualized, okay? Now let's look at this inflationary period. Inflation on average was 5.2%. and equities outperformed T-bills by only 3.7% annualized, okay? So the performance of the market was drastically different during this inflationary period. But wait, it's much worse than that, okay? Why? Well, because investors care about what they can eat, okay? So a premium over the T-bill isn't as valuable if you're getting paid with deflated dollars. One thing. Second, capital gains are not adjusted for the CPI, okay? So the tax burden also went up at the absolute worst time, okay? This was a pretty crummy time to be in the stock market. Could it happen again? Let's find out. Okay, so this was mentioned earlier. I guess someone told Robert Kaplan I was going to talk about this, and he front-run me on it. But so this is the ratio of total federal and state debt to our GDP. Okay, so it's basically about as high as it's ever been. Okay, right after World War II, it was right at this level. This bothers me, okay? We have a Republican president. We have had a long expansion. We are not in a war. I mean, a lot can happen to make this even worse, okay? That is one thing. The other thing is, this isn't the full picture. We have a lot of government obligations, okay, unfunded pensions, social security, government backstops, they're not included here, okay? So the government owes a lot of people a lot. Inflation, who knows what will happen if we see inflation pop up. But this will make it worse, okay? A president, you could see a president saying, well, I don't want to pay the debt. I want to default on our debt. Well, one way to do it is to have an unexpected rise in inflation. The problem with that is if you have deficits going forward, then the cost of getting funding in the future would go up. Okay, so I'm going to turn it over to Peter. Okay.
Okay, thanks, Jeff. Well, as a macroeconomist, I like to think about post-World War II U.S. history in terms of 3 episodes, or maybe we can call them chapters. There was the Great Inflation, which Jeff just described, then the Great Moderation, and then finally the Great Recession. Just to add a little bit of detail, like Jeff just mentioned, the 1960s and especially the 1970s were a period of high and volatile inflation in the United States, and defying expectations that might have associated higher rates of inflation with lower rates of unemployment, working through a Phillips curve trade-off. In fact, as you can see on the right, unemployment trended upward throughout the period too, so that by the late 1970s, the US economy was really experiencing the worst of both worlds, high inflation and high unemployment. When Paul Volcker arrived at the Federal Reserve Board in late 1979, however, he succeeded at doing what Gerald Ford and his buttons could not do, namely bring the inflation back under control using the more traditional method of exercising monetary restraint. After that, the US economy experienced an exceptional period of growth and stability, now known as the Great Moderation. Inflation remained low throughout the late 1980s and the entire decade of the 1990s, and again, defying expectations that might have associated lower rates of inflation with higher rates of unemployment. Instead, as you can see over on the right, unemployment also drifted downward throughout the period, so that by the late 1990s, the picture of the US economy was almost the exact mirror image of how it looked 20 years previously, with low rates of inflation and unemployment. So if you can bring yourself back in time for just a moment to the year 2000, let's say, you can see how, based on chapters 1 and 2, this story seems so compelling to economists like myself, because it seemed like a story of continual progress. The 1970s were tough times for the American economy, the 1980s better, the 1990s better still. Those illusions of nonstop progress, however, were shattered, of course, by what came next. The financial crisis and Great Recession of 2007 through 2009. People like Jeff and myself, as he mentioned, who grew up in the 1970s, still, I think, have trouble believing this today. But one of the most important challenges facing the Federal Reserve at present simply involves bringing inflation back up to the very modest 2% long-run target it's set for itself. But as you can see from the graph over on the left, the US economy actually experienced a very brief period of outright deflation in 2009, even as the unemployment rate reached peaks not seen since the early 1980s. So looking at all three chapters today, certainly the story does not seem like one of continual progress. Instead, the theme that I want to emphasize today is ever-present risks. The risks may differ in their magnitude, they may change in their nature, but the risks are always there, and as investors, we need to be cognizant of them. Now, along exactly those lines, the statistic that I'd like to call your attention to here on this next slide, if you can see it over on the right, it has to do with the covariance between inflation and unemployment. Economists usually talk about means and variances, but as investors, we know covariance is most important. Covariance tells us where the risks lie, and covariances sometimes give us clues as to how to hedge against those risks. And from the viewpoint of covariances, the most important development over this three-part story has to do with the flip in the sign of the covariance between inflation and unemployment. Throughout the period of the Great Inflation and the Great Moderation, that covariance was positive, meaning that bad economic times, periods of high unemployment, were also periods of surprisingly high inflation. That's what Jeff was getting at a moment ago. Since the year 2000, however, and especially in the aftermath of the Great Recession, that covariance has changed sign. It is now negative, implying that more recently, bad economic times have been periods of surprisingly low inflation. So last question. Economically, how can we get our heads around the macroeconomic sources of this sign flip? Or put another way, in the simplest of terms, why is it that the Federal Reserve is struggling so mightily today just to bring inflation back up to a very low 2% target? To see why, we can bring back an economic theory that we all learned about our freshman year in Principles of Macroeconomics. It's something called the classical theory of inflation. But what it really is supply and demand analysis applied to the market for money, or in this particular case, more specifically, the market for bank reserves. So there's the familiar diagram over on the left. On the horizontal axis, we're measuring, as always, the quantity of the good under consideration. That would be dollars in bank reserves. Now, the only trick here is to find out or figure out what should we use to measure the price along the y-axis. It's tempting to say that that should be what macroeconomists like me call big P, the aggregate nominal price level, something like the CPI or the GDP deflator. But when you pause and think about it, the CPI or the GDP deflator, that's a measure of the dollar price of goods, whereas what we want here is a measure of the goods price or value of money. But that's no problem. We can just take the reciprocal or inverse 1 over P. That's the value of money along the y-axis. Now in our graph, the demand curve for reserves slopes down. Why is that? It's because we think about the demand for reserves as a demand for real reserves. As prices rise economy-wide, we move down along the y-axis. Banks have to hold a larger dollar volume of reserves just to support the same flow of transactions. So we move out along the x-axis, tracing out the downward sloping demand curve. Then we can think about the Fed Reserve at any given point in time fixing the supply of reserves, locate the intersection point between the vertical supply curve, the downward sloping demand curve, reflect the intersection point over to the y-axis, read off the aggregate nominal price level or the inflation rate expressed as a rate of change from the previous period. Now, what else did we all learn about in freshman year macro? We learned that when the Fed wants to increase the supply of reserves to the banking system, it can do that in either of two ways. During normal times, by conducting open market operations. During periods of crisis, through emergency lending, through the so-called discount window facility. But either way, the supply curve shifts to the right. The equilibrium moves down along the demand curve towards lower values of money or higher prices economy-wide. And it's that graph that gives us the implication, the main implication of the so-called classical theory of inflation. The idea that money growth, engineered by the Fed Reserve, is what causes inflation. But now we have to take a step back and ask, didn't the Fed Reserve do a lot of emergency lending during the financial crisis? And after that, didn't it conduct a lot of open market operations through 3 rounds of quantitative easing during the Great Recession and its aftermath? Those operations should have shifted, and they did, the supply curve for reserves way out to the right in our diagram, causing a lot of inflation. No inflation resulted. What's going on? What's missing from our theory? To figure out what's missing from the theory, we need to go back in time in our minds one last time, this time to the fall of 2008, the height of the financial crisis. In October 2008, as we all remember, the financial crisis was at its apex in terms of the hysteria. Lehman and AIG were in trouble. The Fed was conducting massive emergency lending programs, increasing the supply of reserves to the banking system dramatically. What's easy to forget, but nevertheless true though, if you take yourself back in time, remember the summer of 2008. Those were the days when every time you drove by your local gas station, the sign out in front told you that the price of a gallon of gas had reached a new and ever more astonishing peak. The world price of oil was rising during the summer of 2008, and that was having a big effect on US inflation. So at the time, Fed Reserve officials knew they needed to conduct emergency lending, but they were wary about rising inflation. So how did they finesse the issue? They started paying interest to banks on their reserves. The idea was to give banks an incentive by paying interest on reserves to hang on to the new reserves created through emergency lending so they wouldn't be lent out and trigger that circular process of deposit creation that would have generated additional growth in broader measures of money and from there inflation economy-wide. We can model this in our little graph by saying what the Fed did by paying interest on reserves is that it engineered an equally large rightward shift in the demand curve for reserves to match the rightward shift in supply triggered by emergency lending. And in our graph, that means inflation did not result. The Fed could accomplish both things at once, emergency lending without inflation. So at the time, this particular combination of policies seemed quite prudent, in fact, quite ingenious, both things at the same time. In retrospect, though, it turned out to be a mistake, and a mistake for 2 reasons. First, all else equal, ceteris paribus, as economists like to say, shifting the demand curve for reserves to the right sent a deflationary impulse through the economy at exactly the wrong time. Just when inflationary impacts of higher oil prices has worn off and been replaced by equally strong winds in the opposite direction, flight to quality dynamics in asset markets, negative wealth effects because of the decline in equity and home prices that were also sending strong deflationary, recessionary pressures through the economy. So by paying interest on reserves at that particular time, in retrospect, the Fed reinforced as opposed to offsetting deflationary shocks that were hitting the economy. But then later on, when it became clear how serious the downturn was going to be, the Fed wanted to conduct quantitative easing, but it was working against itself, having already shifted the demand curve for reserves far to the right by paying interest on reserves. The Fed weakened the effect on inflation that quantitative easing would have otherwise have had. So where does all of this leave us? Look, I agree wholeheartedly with what I took to be the main message from Jeff's introductory talk. I agree that issues concerning the US budgetary situation, political trends in the United States more generally, do raise the threat of a return to 70s-style inflation, where again, the covariance between inflation and unemployment goes back to being positive. In addition, however, investors need to be aware that there's also a new risk in the economy encapsulated in the negative covariance between inflation and unemployment. And it stems from the fact that under existing operating procedures with interest on reserves, the Fed is in a sense working against itself. It's broken the traditional mechanism through which its policy actions impact on prices economy-wide and weakened the Fed's ability to offset forces that might generate another deflationary recession. So let me stop there.
Thank you. And so now Eric Peters, and we're fortunate he's launching an inflation-themed fund. So he's been thinking about this a lot.
Thanks. You've covered a lot. I'm sure I would have failed your class back in the day. It's very, very complex. I think as an investor, I've gained a lot of humility over the 30-odd years that I've been doing this. One of the advantages that gives you is it allows you to kind of step back and look at markets and look at issues like inflation. And I think the observation that I would make is that if we had filled this room with 100 or 200 of the smartest economists and central bankers and different types of policymakers, politicians, business people, investors, in 2005, 6, and 7, and we had laid out for them the policy measures that would take place over the coming 5 to 10 years, which included things like globally taking central bank balance sheets up by $15 trillion, cutting rates to zero. In Europe, they're negative 40. In Japan, they're negative 10. The Japanese own half their government bond market. Their debt to GDP is 250% of GDP. All these various things, if you kind of laid all those things out and said, look, the economy is going to be running at or near or potentially above potential. Unemployment will be back at levels that Jeff pointed out, and Peter were kind of back in the 1960s. If you'd asked, okay, what would be the inflation trajectory? I think it would have been surprising if you'd had even one person who would have been right. And so when I talk about humility, I think that it's important for us to realize that while we may think that we understand it now, having had a decade to kind of study this disinflationary period, I think the likelihood is we probably still misunderstand it. The question is, kind of where we go from there. I think what's been happening for the last decade is we've been trying to put our finger on it and figure it out. And I'd say that the consensus has clustered around this idea of secular stagnation, which is some combination of there's too much debt in the world and populations are growing less quickly, or in some cases shrinking, like in Europe and in Japan. They're still growing here in the US due to immigration. People are aging, and there's been this wonderful kind of boom in terms of technology that's been disinflationary. And we've been able to have this wonderful global trade. So companies have built these terrific global supply chains that have allowed us to tap into cheap labor all over the world. But all of this in aggregate has brought us to this point where inflation is pretty low and growth is pretty low. And as we've tried to address it as a government or as governments, inevitably we've put on more and more debt to the system. And so now we're at a spot where even small increases in interest rates actually really impact economies and slow them down. So we're kind of stuck in this secular stagnation world. And I would say that, like any theory and any consensus that takes a long time to develop, by the time it's pretty fully developed, it looks obvious and it kind of appears that the world could look none otherwise. And so I'd say that from my perspective as an investor, we're somewhere in that zone. You know, maybe have a bit longer of a period of stability. But I would say that, interestingly, the markets are really priced for that. So if you look at 10-year US inflation swaps, which is a market-based measure, it's not a Fed-based measure, it's just a pure market-based measure of where does the market think inflation will be on average for the next decade. It's 1.75% CPI. And if you look at an equivalent type measure in Japan, it's 12 basis points of positive inflation. Europe, 1.3. UK with Brexit, it's a bit higher, it's over 3%. But these are extremely low levels of inflation. Interest rates have adjusted, prices have just adjusted. So as an investor, you don't really get paid to bet on the status quo. And the question is, could something different happen? I would say that there was a very famous speech made in December of 1938 that could have been made today, talked about declining population growth in the US, talked about rapid improvements in technology that were going to lead to a perpetual environment where there's less capital investment because we're becoming so much more efficient. And consequently, we were going to be in this really kind of stagnant growth period. And within a couple months, we were, World War II had started, and within 2 years, inflation was 10%. So I'm not suggesting that a war is on the horizon, although it could very well be. But my point is that things change, right? And so once a market's priced for effectively no change, I think it's wise to look for reasons that it could change. From my vantage point, the big change that's happening in the world is that we're having this real political shift that's taken place. We obviously are very aware of it here in the US, but it's happening in the UK. It's certainly happened in Italy. I'd argue that there's been a political shift in Japan. Abenomics seems like it's status quo right now, but it's really pretty revolutionary policy. Eastern Europe has changed pretty significantly, and I think when you look at what has driven a lot of the political change toward anti-establishment candidates, I think if you kind of just squint your eyes, you can see that it's probably the case that people feel like they've been left behind economically. It's probably the case that this division between capital and labor has gotten to such an extreme point. In fact, it's gotten to where it got to in the late 1920s, that people have just said, they haven't put their finger on and said, I want more inflation. They've just said, I want something different than this path. And this path has been one that's been characterized by policies that have led to low inflation, very activist central banks, deep global supply chains. And so I think the political response that we're beginning to see, if you put it in that context, are things to kind of dismantle these drivers that led us to this place. We're actively attacking global supply chains. We are going in here in the US, but not just in the US, we're going after immigration. We're trying to get companies to reshore. What are we trying to do? We're trying to create a kind of a shortage of labor relative to demand and boost wages. And by the way, even though inflation's remained muted, oil prices have been low, wage inflation is unambiguously picking up. And maybe we'll talk about it later, but there are numerous parallels between where we are right now economically and where we were in the 1960s at the outset of that last big inflation.
Thanks. Peter, now might be a good time. I know politically we've heard a lot about MMT. Can you just talk about that just a little and the extent to which you think this theory holds water?
Sure.
Okay.
Well, I'm glad Eric brought up the time period of the early to mid 1960s because there are certainly a lot of similarities. It's almost eerie how similar things are today compared to back then. And the ideas, loosely speaking, surrounding so-called modern monetary theory, or MMT, are very similar to the political, social trends that fed into the economic decision and policy making of the mid-1960s. It's easy to say, well, with inflation so low, why not try and push a little bit harder on the Phillips curve, get wages growing, get economic growth back up, and look, even if inflation goes up by a full percentage point, that just brings us to 2.5, making up for an extended period where inflation ran below 2%. And likewise, you could say, well, the deficits or the stock of debt outstanding in Jeff's graph from earlier, it looks astonishing. But on the other hand, why is the 10-year Treasury bond rate or note rate 2.25%? Doesn't that suggest that there's additional fiscal capacity? We can spend more and borrow more and do more of everything. Secure militarily, address national security concerns, and also get started on ambitious social programs that would be directed at some of the problems Eric mentioned just a moment ago. Those were the exact kinds of ideas that were in the air, I think, in the mid-1960s. Inflation was low, budgetary pressures seemed to be building, but not yet a problem. The United States was fighting a war in Vietnam, but there was a heavy pressure for numerous social programs. Why not just try it? What could be the costs? The problem with all of that kind of thinking is that strategies like that work well up until the point where they stop working well. You can get inflation creeping up for a while, like it did during the 1960s, but then it gets out of hand, and then it's really, really costly to make the corrections. Similarly, thankfully, we have no experience of this in the United States, but we know from other countries that have experienced terrible sovereign debt problems. Things are going fine until they stop going fine. What would happen if at a Treasury auction the demand just wasn't there? It would be a real problem. So I can see the appeal of MMT today, and I see in it echoes of what happened in the 1960s. But that's exactly the problem when then you say, well, but look at what happened next.
Just some comments on that, I suppose. If you look at where we are right now, I'd say that we've been in a world dominated by central bank activism, and that's been the case over the entirety of my career, really. So, I started in '89 with Greenspan at the helm, and lo and behold, if you look at some of those debt charts, the debt is going up, and the interest rate and inflation rates are coming down, and so we've now hit the zero bound. The U.S. has been able to lift itself off of that, albeit with a 5% budget deficit at full employment, with the economy running above capacity, which is a pretty unique policy mix. But we've been able to rise above it. Europe hasn't. It's still stuck at negative 40. Japan is negative 10 basis points. So I think what is highly likely, and this goes along with this populist move politically, is that what we are in the process of seeing is this transition, this handoff of the baton from central bankers who really have quite limited policy tools at this point. They have theoretically they still have robust tools, and that they could just print as much money as they want. Practically speaking, the way they have conducted policy in the public mind has been a way that has amplified inequality. So I think what we're seeing is central bankers are going to become less important, and politicians are going to become more important. And when I say politicians become more important, you think about the big policy levers that you have as governments. One of them is monetary, and you can either allow your central bank to be independent or not. And most developed countries have chosen over the last couple decades to try to maintain their independence, but that's not always the case, and it's not written in stone. Ultimately, the central bank serves the country. Or the government has fiscal. And while these interest rates have come down and debt has gone up, the government, I think, has allowed the central bank to be the agent of stimulus. But now that we're at this zero bound and the central bank tools are less potent, I think it's inevitable that governments have to, will use fiscal much more aggressively to accomplish what they want. and instructs this new modern monetary theory, which isn't altogether new, and it may be as old as the sun, but it gives it kind of intellectual backing to this idea that in these big developed economies with strong institutions, you can borrow a ton of money and your central bank can even buy it, and as long as it doesn't create inflation, you shouldn't have a big problem. And so whether we believe that that is true or not, or whether it's fraught with risk, it's certainly fraught with risk, but whether we'll succeed in kind of implementing MMT, I think there's very little question in my mind. It seems a natural progression of this policy of stimulus. And once you run out of monetary bullets, you got to go to fiscal, and now we've got this great theory that I think people will embrace on the left and right.
Thanks. So, when I think about as an investor, what should one do? One lesson from the 70s was, well, it seemed like real estate did okay. Today, when I look at real estate prices, especially on the coast, it's hard for me, even though I tell my students markets are efficient and the price is right. It seems to me that we have property values that are too high. So it's unclear to me that an investor who's concerned about inflation would, want to lock into real estate now. So Peter, Eric, do you see? How do you think an investor should respond if they're concerned about inflation reappearing?
It's extremely difficult. So we have a number of products at the firm, and as I mentioned, or as Jeff mentioned, we're launching an inflation product because I think looking at over the next 5 or 10 years, it'll be an important place to invest and look for opportunities. As a consequence of that, been all over the U.S. and Canada and Europe and even Australia, speaking with large allocators, and I'll tell you that this is a topic that everyone is very interested in because they know, by definition, after such a long period of low and stable inflation, their portfolios are extremely exposed, whether they realize it or not, to a change in that. Inflation is one of the biggest drivers of asset prices, and yet it's been a factor that no one has had to really think about. But when you sit down and you kind of walk through their portfolios, it's interesting that they often have pretty big allocation to real estate. But real estate has been extremely inflated because this process of creating low and stable inflation and QE has led to very long-dated interest rates being extremely low. And that's essentially how you price real estate. And so we, unlike the 70s, we will be going into, and if we do enter an inflation, we'll be entering an inflation where interest rates will likely be very vulnerable, and everything has been priced off of these extremely low interest rates. And so it's just not clear that really estate will be a hedge at all. The question is, what is the hedge? And unfortunately, there's no super satisfying answer. And we've gone through, post 70s, and everyone in this room, if they're an investor or an academic, we've had this really unique period where these trends have all led in the same direction. Interest rates have come down, and inflation has, long rates have come down, curves have flattened, all these kind of wonderful things for investments. And so you've been able to have a portfolio of long equities and long bonds at low volatility, and so you've even been able to leverage those. And when one falls, another tends to rise, and vice versa. So it's been this wonderful period. But in an environment where bond prices fall and equities fall, and that impacts real estate as well, there just aren't a lot of places to hide. I think investors will have to move quite a bit into the front end of the curve, into fixed income securities. But it's not going to be a buy and hold type period. It's not going to be as easy to have a buy and hold portfolio as it's been for the last few decades.
Thank you. So why don't we take some questions from the audience? We have some microphones. Is there a microphone? Okay, yes, right here's one.
So what do you buy if you want to hedge against inflation?
We
Or sell?
Yeah, yeah. Well, if you look at the 70s, and incidentally, we think that there's a lot of room between where we are right now and the 1970s inflation. So we could have an outcome that's very much in the middle. I'm open-minded to anything, but it's going to be a very difficult period for equities, and I think we're probably starting to see that. I think in America, we tend to be used to this idea that equities go up perpetually, just on a nominal basis. If you look at Japan, Japanese equities, their broad equity index is where it was before my career started. It's where it was in about 1987. European equities, their equity index is where it was about 20 years ago. China is where it was 12 years ago. So we've had a very, very long bull market. It's been an extremely long bull market just from the '09 lows, but even going back to kind of the early '80s, we've had a very long bull market. And it stands to reason that we go through a period of that doesn't look terribly different from the '70s, where there was a lot of volatility. So equities peaked in 1968, and they didn't get back to that nominal level till 1981, and they had 50% drawdowns, a couple of them in that time period, the S&P. So I think there'll be opportunities when equities seem to be euphoric. For instance, if we get a trade deal or something like that, very good time to be lightening up your equities, significantly, moving into shorter dated tips, not longer dated tips. A lot of tips ETFs are longer dated, and so you might make money on the inflation protection, but you lose a lot of money because interest rates jump up abruptly. But those are the ways that most people can kind of access and toggle their portfolio around. Other things are inflation swaps, and you need to have. It's a harder position to put on unless you're running a hedge fund.
How about commodities?
Commodities is the tempting thing, and the problem with commodities is that gold was, you look back at the '70s, and it was a great time supposedly to be a commodity investor. A lot of it had to do with oil. Oil outpaced inflation. And there are all kinds of oil shocks to the kind that amplified that price. Gold outpaced inflation as well. But gold had been kind of locked in place by the government. It had been liberated. But the other commodities, for the most part, they just kept pace with inflation. And it's just a hard call. They're very volatile as well. Most investors really struggle to hold much in the way of portfolio holdings in commodities.
Bitcoin.
I own a little bit of Bitcoin, just a tiny amount, just because it keeps my attention. I'm intrigued by it. I've always felt like these crypto. For years, I felt like cryptocurrencies, and this is completely wrong, by the way, in terms of trade, but I thought that they would eventually get to the point where there was a winning technology, and then the government would co-opt it. Because governments don't tend to give away power, and giving away the power of seniorage is something I don't expect any major government to do. It's possible that they get so widely adopted in big pension funds and endowments, maybe like yours, and invest in it at some point, and then there's enough political power that they don't get co-opted by governments. But at some point, we surely move to a digital currency. It's like hard to imagine 100 years we're still going to be printing paper bills. But so I think crypto will be part of it, but I don't know how to bet on one versus another.
There's a question in the back.
Thank you for this session, in that it's affirmed my decision 45 years ago to be a history major. And maybe it's because I only understand a fraction of what you guys have been talking about, but my question is around negative interest rates. And it just feels as if there's more to be said today about negative interest rates. And I look at Japan for 30 years with, if not negative, very, very low interest rates. And I know that 6 years ago and 4 years ago and 6 months ago, even, I assumed that interest rates here were going to be on the rise. And lo and behold, they're not. And I think we have Switzerland and Germany and maybe half dozen countries in Europe and China and Japan with negative interest rates. I'm confused, as I've just made very clear. So just speak to negative interest rates and the impact on all of this, if you would, for about half an hour, if you could.
Peter, do you want to take it first?
Sure. Well, one historical analogy would be to go back to the period of the Great Depression in the United States. The mistake that policymakers, or part of the mistake that monetary policymakers made during the Depression, is that interest rates were very, very low because of, first of all, deflationary forces, second of all, flight to quality dynamics. And usually in normal times, when expectations are well anchored, we think about low interest rates as synonymous with stimulative monetary policy. But in that particular case, interest rates were low for other reasons. And we know from the work that Milton Friedman and Anna Schwartz did on the history of the Great Depression that, in fact, if you looked at trends in the stock of money, to the contrary, monetary policy was, not only not expansionary, but extraordinarily tight. So I think the lesson we can draw from today's experience is that whereas in normal times, certainly low interest rates can be indicative of accommodative monetary policy, that is not always the case. And then I would come back to the story that I told in my own presentation. When the Fed Reserve introduced interest on reserves, the whole game was to have a monetary expansion necessitated by emergency lending, but without causing inflation. So the idea behind paying interest on reserves was to prevent the expansion in the money supply from being inflationary. Then somehow, bureaucratic inertia perhaps, or just the fact that it sometimes takes a long, many, many years looking back on something to really understand what's happening. The Fed and other central banks have kept interest on reserves in place and then wondered why, no matter what they do, it doesn't cause inflation. My answer would be, you designed a system that would allow you to expand the supply of money without causing inflation. Is it now really a surprise that we don't see a lot of inflation?
I would just add one thing to that, which is looking at it from a completely different angle. I really don't know the answer, but I would have observed, and you're a historian, there are various periods in economic history where there's more or less freely available capital, and it strikes me that there's just too much capital in the world right now, and that it needs to get destroyed. And one of the ways you can destroy it is through war, historically. One of the ways is through financial repression, which I think is what we're trying to do right now. So I think that the government's desperate to get inflation higher. Politicians are desperate to get it much higher than central bankers. So central bankers are fixated on 2%. We don't know why necessarily. But politicians are trying to figure out this issue around entitlements that you brought up. I'll tell you one thing. If you're going to screw a lot of people, which is what's going to happen over the next 30 years, is we promised all these entitlements, and it's just not possible to deliver what we've promised. It's a lot harder to do that in a stable inflation world, rather than a world where prices are starting to move around, and a guy can get a pay raise and feels good when he goes home to his family, even if at the end of the year it doesn't add up to anything, or it's even negative. I think that what governments are trying to do, and I'm not even suggesting there's this master plan. I think it's this, in a world where there's just too much capital, and we haven't had a big war or something like that to destroy it. we're getting rates down to such a low level because people just have capital to put into bonds or put into credit, and people don't seem to want to take a lot of risk, and the central bankers are kind of happy to get rates quite a bit lower than growth, because that's one way to achieve financial suppression and try to get at that big debt pile that you had up there. If the U.S. economy can, and all these other economies can grow quite a bit above the levels of interest rates that they have to pay for the next 15 or 20 years, and then if we can get inflation up a little bit, well, maybe we can work out this debt pile at the same time that we really stiff a lot of people in terms of their entitlement promises.
I think there's this other issue is we're hearing a lot about wealth inequality now. Also, one observation is the millennials have a lot of debt. Is inflation a way to solve inequality problems, or will it make it worse?
Definitely. If you're a millennial, you want inflation. You've got this big debt pile. It's at some interest rate that the government's given you. You just want to figure out how to earn more money. It's been tough. You've read every article in the world saying your financial future is going to be less good than your parents, and theirs is less good than their parents. You unambiguously want inflation. If you look at some of the inequality, if you just take the late 70s, the private financial asset to GDP ratio in the U.S. was 2.4. Today it's 4.4 times. So people who have money have gotten really rich from the late 1970s. But part of that is saying that in the 1970s it was a lot more even. And if you look at profit margins, corporate profit margins from back then, they were down around 6%, and they're up at basically all-time highs at 12% right now. So, if you are a young person, you want inflation. If you're an old person, you really don't want inflation. And so that's what Japan is. Japan is a lot of old people, and one of the reasons they really don't have inflation is because the vast majority of voters there are terrified that what money they've saved and socked away their whole lives, locked up in 10-year JGBs at minus 10 basis points, they're terrified that they get a big inflation they can't eat. So, but young people, it's wonderful. Wonderful. You said it wasn't happy.
Yeah,
you said no one was happy when you were a kid, but
it is their way out.
Yeah, it's their way out.
Yeah. Yes.
So let's assume that inflation does trend higher in the next few years. What milestones would any of you suggest we'll see along the way? What will tell us that it's actually is happening?
Could you pull up that chart of CPI that looked at the 1960s? That's kind of that inflation period is interesting. I'll give you the analog that we look at for the 1960s. So really quickly, 1964, U.S. had the largest tax cut in its history up until that point. It was a 20% tax cut. Equity market went up, posted a high in 66, and then had a 20% correction. The Fed had been raising rates, as I think maybe you can't see. Equity market fell 20%. There was a little bit of a dip in inflation. I think you can actually even see it on that chart. The Fed started cutting rates. Equity market went up, made a new high in 1968, and then it was just checkmate for equities, and you just saw inflation kind of creeping higher. So even in these periods, if you look historically where inflation rises, there's variability. Like right now, I think people are looking at headline numbers and they're relaxing, but oil has had a very dramatic decline, and that's the biggest driver of headline CPI. So I think what you'd want to see is the Fed getting easy, which they're doing right now, responding to an equity market, which shouldn't necessarily mean one thing or another to them, but it obviously does, and then you just see inflation kind of continuing to creep higher. It probably comes from wages. We'll see about the dollar, but I think you just kind of keep an eye you keep an eye on that. I
suppose if I could follow up, and maybe you have some thoughts on this too. What I agree wholeheartedly that the political and economic risks of higher inflation in the future are certainly poignant and there. The only thing that nags at me, though, is why then the 10-year nominal Treasury rate at 2.25 when the Fed has told us that it expects 2% inflation over the long term. That means the real return from holding long-term treasuries is practically zero if you believe inflation going back to 2%. Even worse if you believe that inflation will go higher. So what would be the sign of a change in sentiment? I think maybe you would start to see long-term bond rates behaving the way they used to behave in the 1970s and even maybe into the 1980s, where, periodically there would be the sense in the bond, they used to call them the bond vigilantes, right? The sense that the Fed was letting inflation rise and nominal bond rates went up. Do you see the 10-year rate in any way as an indicator reliably of inflationary pressures or lack thereof?
Not right now. And I think that that's because I sound like I'm confident about this. I have a lot of humility around this, but I think that I think the market has this mindset that it's all about the Fed, and the market has this mindset that in the next recession, no matter what happens between here and there, the next recession rates are going to zero, and the 10-year is going to go to 1 to 1.25%, roughly speaking. And so when you look at the 10-year at 3.25, which is where it was, or 2 3/4, 2.5, 2.25, which is it's not even 2.25 now, but these levels, there still are enough investors in a world where there's just a ton of there's too much capital that are saying let me just put some money in there, and I think that that's what's driving it. I think what the market misses is that we're shifting from this world dominated by the Fed to a world dominated by politicians. And by the way, I think it is at least in the kind of world that I would expect to see given these levels of debts and entitlements. I think what we'll end up with upward pressure on interest rates, but we'll have very active as central bank that will balloon its balance sheet out far higher than it is right now. And we'll call that MMT, and it'll probably work for a while, and then we'll see. But it makes it difficult to look at the fixed income markets as predictors of where inflation's really going right now. And there's a deflation. If the economy turns over with all this trade stuff, there will be a deflationary impulse for a short period of time. But if you look at the tariffs that are coming through, there are a lot of inflationary impulses that are also coming through, other than just economic weakness.
Well, since Andy has the microphone,
I have a question. I'll keep it simple for you, Jeff. Well, first of all, I think there's probably only a few people in the room who, Bill might be one, and growing up in New Jersey, going to the gas station on the wrong day of the week so you couldn't get gas. And I remember that, kind of the off-on day and all that stuff in that inflationary time, like that one decade. That's the only decade we've had that high inflation based on the chart. But, and I'd just like to ask, and I think, Peter, this has been a theme you've mentioned here, and the deflationary issue and the risk of that, given, as you say, the world is awash with capital, yet we have all these promises we've made, the level of debt, and as Jeff points out, beyond debt, we've made a lot of promises. So what do you think the risk of deflation is, which would really be a different ballgame? And given all those variables and your covariance, what would that do to the markets and investors and so forth? Because these lines are more risk going below to negative interest rates, or at least as much as going up.
Well, the nice thing about the deflationary risk is what Eric mentioned, that there's an easy solution, which is 60-40 stocks and bonds, because the economy does well, the equity market does okay. We have a deflationary recession, flight to quality plus decreasing interest rates, bonds do all right. So I think that formula will continue to work, if that is the scenario going forward. But the real risk is that if we flip back to something more like the 1970s where where stagflation is the risk, then both sides blow up on you. And unfortunately, I think that there's no place obvious to hide.
You call it stagflation? Could you just expand on that? Just for me, you know.
Oh, well, stagflation meaning the unfortunate combination of high unemployment and high inflation. So just when the economy is taking a hit and the stock market is taking a hit, bonds get hammered as well. Right.
Okay, well, thanks. Thank you.
Thank you.